the saying, you gotta have a plan, man.
Now, I know this plan is foolproof. Check this out.
Well, you do for 2023. Well, don't worry about it. Carl White and the Marketing Animals, they have your back. They got a one-page business plan that you can download, free of charge, of course. In order to get it, all you have to do is click this right over there. So who's your mortgage rate oracle? You know, your fortune teller, soothsayer, clairvoyant, or prognosticator. You get the idea. You know, you can't swing a dead cat around without hitting somebody who's going to tell you the future of mortgage interest rates, can you? And like some of them are good and some of them are bad. I'm just kidding, but the statement's probably accurate. Well, here's something to add to the pot.
The Fed's Mester sees rates rising more than most policymakers have forecast.
Yeah, you know, Loretta J. Mester, president and CEO of the Federal Reserve Bank of Cleveland. This guy pictured here says, we need to continue to bring up interest rates into a restrictive stance. We did a lot of work this year, moving rates up aggressively. We will need to hold them there for quite a while in order to get inflation on a sustainable downward path.
Mester goes on to say, against the Fed's projection that the current federal funds rates of between 4.25% and 4.5% will rise to 5.1% next year. I'm a little higher than the median.
Just ruining lives. I mean, our economy is like that kid at school who constantly finds himself in the principal's office because they simply can't make the right decision. Policy got us here, and now policy is going to fix it? Or are we just going to be that bad kid and keep pushing the blind kid off the curb? In our industry, make no bones about it. Policy to fix and then fix and then fix and then fix has done nothing but ruin lives. And this is inside and outside of the mortgage and real estate industry. When are people going to learn that, like, when we have less government involvement, the better things tend to be? With that said, let's just keep the bloodletting going. Now, what else do we got going on?
Well, car repossessions are up. In recent months, the number of people behind on their car payments has been approaching pre-pandemic levels. And for the lowest income consumers, the rate of loan default is now exceeding where it was in 2019. This, for the mortgage industry, might just be the canary in the coal mine, foreshadowing higher mortgage defaults because first goes the car and then goes the mortgage. It may sound bad, but foreclosures amount to listings and loans for our industry. Not to mention people who pay their taxes will now occupy these foreclosed homes.
Check this out. What in the heck is going on with this building of chairs? Look at this. I just had to bring it up. I saw it over the weekend and I can't make heads or tails about it. Anyways, with rates going up, so is demand for riskier loans, those being ARMs. 5-1, 7-1, 3-1, 10-1, whatever you got. Listen, everybody knows that rates of today are not going to be rates here for 2023. The loans that you sell today will be refinanced next year, just not too soon. Seriously, sell ARMs. And when I say sell, I mean sell. Sell ARMs. Explain the benefits. And don't forget that Oaktree has a 40-year, 10-year interest-only loan. That's like an ARM on steroids. Be the professional loan officer. Run both scenarios, the 5-1, the 40-year with a 10-year IO option on it, and give it to your clients and let them decide. Give them the scenarios and the information and the answers and any questions that they might have, and you better be able to answer those questions. Now, if you need help, reach out to my friends over at Oaktree. They will explain all of this stuff to you, not to mention how to sell these suckers as well. If you want to get more information from Oaktree, just click this banner right over there, and I can't wait to see you until tomorrow.